Good morning, everyone, and welcome to today's webinar on agricultural conditions in the Federal Reserve's 9th District. Before we get started, a little bit of housekeeping. This webinar is part of a series of webinars that we do on regional economic conditions, and I'll be placing a link in the chat box on Zoom to those previous webinars. And if you've been with us for those previous webinars, you'll know that we do follow up with each of you sometime next week with an email that contains a link to the slides for today, as well as a link for today's video. Welcome, my name is Carmi Matson. I am the Assistant Vice President of Regional Outreach and Public Programs at the Minneapolis Fed. I'm joined this morning by Joe Mahon. And before he kicks it off, I'd also like to let you know that we do have another Regional Economic Conditions webinar upcoming on Friday, December 3rd at 9 a.m. Central Time on conditions in the construction sector featuring Ron Wertz. So I'll be placing a link to that registration site in the chat box as well. And then as always, when we sign off, we'd love to get your feedback on this webinar. You'll receive a little pop-up survey and we'd love to hear from you. Joe will have a few moments at the end of the presentation for entertaining questions. So if you have questions while he is speaking or afterwards, you can type those in the chat box on Zoom and I will pose those to Joe. Thanks for joining us. And with that, I'll turn it over to Joe.
Okay, thank you, Carmi, and thank you to everyone out there for joining us this morning. I'll be talking about agricultural conditions, but specifically presenting the results of a survey that we just released this week of agricultural lenders. Before I get started, just a standard disclaimer reminder that I am speaking for myself and not necessarily the Federal Reserve Bank of Minneapolis, my employer, or my colleagues in the Federal Reserve System. So as I mentioned, I'll be running down the results of our latest quarterly agricultural credit conditions survey. I'll just start by describing exactly what that survey is so you can kind of understand where these numbers are coming from before I get into the survey results. Just to give you the summary takeaways in case you need to leave early this morning, the bottom line is sort of surprisingly, given that we've seen the worst drought in our region that we've had in decades. Farm finances are actually holding up pretty well. In particular, farm incomes are still increasing through the third quarter of this year. There are important exceptions to that, which I'll get into. The outlook for the fourth quarter is for continued growth in incomes and improvement in farm balance sheets is a little bit more moderate than what we've seen come in so far this year, but still an optimistic outlook on balance. Very strong growth in land values. I'll detail that by states and talk a little bit about what we're seeing happen with land values and cash rents, which came in very strong in the third quarter. And then I'll get into a little bit more detail about what we can say, at least from the results of this survey, about the impact of the drought that we saw this summer on agricultural producers around our region. So just a quick background when I talk about our region, for those of you who are unfamiliar, I'll be speaking about the Federal Reserve's 9th District, which is the sort of upper Midwest. You can see the states in our region here. Our region covers the states of Minnesota, North Dakota, South Dakota, Montana, and then we have northwest portion of Wisconsin and the Upper Peninsula of Michigan. For the purposes of this survey, we don't really include the Upper Peninsula of Michigan in the agricultural credit conditions survey, largely because there's not a lot of large agricultural production operations in the Upper Peninsula due to the climate and growing conditions there. But for the other states in our region, as you might imagine, agriculture is a very important industry, really kind of at the core of our economy, both historically and in the present in our region. And as such, we conduct a quarterly survey to sort of check in with ag lenders in our region. So as I mentioned, we do this survey on a quarterly basis. We do it after the end of the quarter, looking back over what happened over the previous 3 months. You can see the months in which we conduct it. What I'll be talking about this morning are our results for a survey that we just conducted in October and covering the period from July through September. So really the peak toward the end of the growing season for some of our most important crops in the region and getting into harvest time. So it's a really good time to check in with farm lenders to get a pulse on where things are going in the region, where they expect to see production numbers come in, maybe a little bit before we get some of those official statistics from the USDA. And I should point out that this is not really a scientific survey of agriculture, in the sense that what we're not doing here is taking a random poll of farmers or other agricultural producers in our region, but rather we're connecting with member banks, Federal Reserve member banks. So these are state member banks who are heavily concentrated in agriculture. And what we mean, the way we define that for these purposes, is having more than 20% of their loan portfolio in agricultural loans. So operating machinery, real estate, and other loans to farmers and agricultural producers. So the idea is not necessarily that we're getting a sort of a statistically significant sample or results from doing a random survey of agriculture, but rather that we're kind of checking in with a panel of experts. So these are bankers who lend to farm producers in their region, and really therefore have a very good sense of what the financial condition of their customers are and how they're doing in terms of their businesses and what they expect to see. Again, we asked them on a quarterly basis what they saw happen over the previous 3 months, and we asked them about their expectations for the 3 months going forward. I'll show you some of that historical data, but mostly I'm going to be focused on the results that we got in our latest October survey, which, just to put some context on it, we had 53 bankers respond in October. It's a little bit lower than we normally get, but pretty good broad representation from across our region. Again, bottom lines for this survey, most of our lenders are reporting that farm incomes continued to grow on a year-over-year basis in the third quarter. Sort of corresponding to that, we saw increases on balance in capital expenditures, purchases of equipment and buildings by farm operations, and also their households, consumer expenditures by households engaged in farming as well. Those are up, just looking at the breakdown of the survey, a little bit more moderately than incomes. As you might expect, when you're seeing a period of income growth, the rate of loan repayment has increased. So again, we're checking in with bankers here. So one good metric that they can look at is the rate at which both their borrowers are demanding credit, and the rate at which they're repaying it, the rate at which they're renewing outstanding loans that they have or rolling them over for another term. And so what they told us was that the rate of repayment was steady to up on balance. Loan demand, as you might expect, given sort of higher cash in farming, is down, and renewal activity is down as well. Just a kind of broad indication that farm finances are coming in pretty strong. Their outlook for the fourth quarter is positive, and largely driven by what we've seen in the markets for agricultural commodities, sort of continued strong commodity prices. The really important thing I want to point out, again, because the big story this year in our region was this drought. The drought was really most severe in some of the kind of core wheat producing and small grain producing regions of Montana, and then also in North Dakota, specifically Western North Dakota. The drought was widespread across the region, but that's where it was most severe, and that's where it had its harshest tolls, and in particular, the toll on livestock, cattle producers, ranchers and cow-calf operations really seems to be the most severe, largely owing to the limited availability of hay and higher costs of feed that they're facing. And again, I'll show you what we saw in terms of a pretty significant increase in land values. So just to kind of get into the breakdown of survey results, most of the questions that we ask are on a very simple basis. We just ask them, did farm income increase? Was it steady, or did it decrease over the last 3 months relative to the same period a year earlier? So quarter 3, 2021 over quarter 3, 2020. Nearly 3/4 of lenders told us that farm incomes grew over the past 3 months relative to a year ago. A small portion of them telling us they were steady, and very few telling us that farm incomes decreased. You can see the breakdown for household spending and capital spending, positive on balance, but we had a higher proportion of the respondents tell us that those spending categories held steady. I do want to point out, we also got a number of comments in the survey about the sort of ongoing supply chain disruptions that are affecting the rest of the economy. It's affecting agriculture as well. And some comments indicated that capital spending might have come in higher. It's just that that it's taking longer to purchase agricultural equipment right now because the supply chain bottlenecks are affecting production of combines and tractors, just like they're affecting the production of automobiles and other manufactured goods as well. And so a number of comments indicating that capital spending might have come in stronger, but for the long lead times to purchase new equipment. So just to put the income picture in a bit more broader historical terms, you can see I've got this plotted all the way back about 25 years to when we began doing this survey in the mid-90s. And this is just the proportion of lenders over time on a quarterly basis who've told us that agricultural incomes either increased or held steady in the previous quarter relative to a year earlier. And this is just in percentage terms, you can see there. And what you can see is in the most recent quarters, that's come in pretty strong. And we're on basically a year now of stronger growth in farm incomes. And that's coming off of a period of about 5 years where income growth was weak, where we saw pretty low farm incomes. In fact, a lot of producers in our region operating at a loss for some of those years from about 2014 through mid 2020, and that was largely due again to market conditions during that period, where we had a sort of a prolonged period of low commodity prices. If you look back now, we've seen over the last year growth in income consistent with the really booming years that we saw at the beginning of the last decade, where again farm prices, commodity prices were pretty strong during that period, and that was leading to higher incomes. And that's what we're seeing right now. It's worth pointing out that earlier during this period, we also did have a number of lenders report to us that the government assistance programs were an important part of the growth in income, in particular the coronavirus food assistance program and some of the other pandemic relief programs that were targeted at farmers have been of big assistance, and also not just to farmers, but also to livestock producers as well. Some of those programs were targeted at them as well. And those have been a boon to farm incomes, and that's consistent with the farm income data that we get from the USDA as well. So again, just to kind of put in context, over the last year, we've seen pretty strong growth in farm incomes, and that's a reversal of the picture that we'd seen over the previous few years. Turning to some of the other metrics of financial condition that we look at for farm producers. Again, given that we're checking with bankers, we can ask them what's happening with loan demand. The largest share of lenders in the most recent period told us that loan demand was down relative to a year earlier. Relatively similar share saying no change. And about 1 in 6, as you can see, they're telling us that loan demand increased over the period. You can see the results for repayment rates and renewals. Repayment rates are a little bit more steady, larger share, about nearly half, indicating that loan repayment increased in the previous 3 months, but a slightly more than half telling us there was no change. And then renewals, the tendency of producers to roll over existing loans that they have, mostly held steady over the period. Turning to the outlook for Q4, the last 3 months of this year, again, the outlook is positive on balance. So you see about 2/3 of lenders expect income to continue to increase over the period. Most of the rest expecting incomes to hold steady, slightly larger proportion than in Q3, expecting decreases in incomes, but the pretty strong majority expecting increases in incomes. Fairly similar picture for household and capital spending. You can see that there's a majority, though, expecting increases in capital spending. That's again owing to greater cash availability, and again perhaps to expectations that some folks who are waiting for delivery of equipment are going to see delivery in the fourth quarter. Looking at the outlook for loan demand, pretty stable overall. Slight increase forecast in loan demand. Again, the largest share expecting no increase in demand for credit by agricultural producers, and repayment and renewal activity generally expected to hold steady. just about an equal proportion of lenders expecting increases versus decreases in renewals, slightly higher or a higher percentage expecting increases in repayment rates. But again, the lion's share expecting things to hold steady. One other thing that we saw continue over this past quarter is sort of a continued downward movement in interest rates. They moved down only a small amount on a quarter-over-quarter basis. So again, these are lenders. They determine what interest rates they're going to charge on their loans, and we just ask them what they're charging for a variety of categories of agricultural loan. And as you can see, those have been trending down steadily over the last few years. They moved a little bit more sideways in the last quarter, largely because they're already so low. But for most categories of loans, they came down anywhere from 10 to 30 basis points. The one exception I'll point to is machinery loans, which on average ticked up slightly, but that's maybe small enough that that you wouldn't consider it significant. But if you just look at that trend there, they're kind of moving sideways to slightly down over the period, and that's been a boon to farmers as well. And that brings me to land values. You can see from this chart that we saw really strong growth in land values. I do want to just give you a couple of qualifications on what I'm showing you here. So again, this is coming from our results, our survey of farm lenders in our region. So these are people who understand land values in their area pretty well, given that they accept land as collateral for a lot of loans. And they pay attention to recent sales in their area. So they're a pretty good source on this. We tend to find that we track this on a quarterly basis, and when the USDA releases its annual estimates of farm values, those tend to track together pretty well. So the USDA does a much more rigorous, sort of statistically, it's a geospatially weighted sample of land values across states. All we do is we just take a simple average of all the lenders in a given state. So if we had however many lenders from Minnesota, we just average their responses, and that's what we give you in this chart here. So you can see, on average, non-irrigated farmland values across our region are up more than 20%. On a year-over-year basis, so that's comparing to a year ago. And we do look at the lenders. We're only looking at the lenders who responded in both of those periods, so it's an apples-to-apples comparison. So among those who responded in 2020 Q3 and also in the most recent quarter, what they're reporting for the price of an acre of good quality irrigated farmland in their area is up more than 20%. You can see it's up even more in Minnesota, and about at the same level in Wisconsin. Slower rate of increase in North Dakota, and actually we got a negative reading in Montana. Again, I'll qualify the Montana reading just to mention that we had a fairly small number of respondents from Montana. But you might look at this and expect that maybe the harsher effects of the droughts in those states were affecting what we're seeing for land values there. We also ask about cash rents. So what are the prevailing rates that producers are paying to rent land to produce on it from another owner? And those also jumped not by as much as farmland values, but again, double digits across the region, nearly 12% for the district as a whole, nearly 15% Minnesota, just about 12% in South Dakota. Again, negative change in North Dakota, possibly owing to some of the effects of the drought, lower expectations for what you might be able to produce on an acre this year versus a typical year in North Dakota. Not exactly sure why survey respondents are responding the way that they are, so you kind of have to sort of do some guesswork to try and get inside their heads. And all I can tell you is that this is what they're telling us on average for these states. And then before I turn it over and take questions, I want to spend a little bit of time talking about the drought, because that was the biggest story in our region this year. This is the USDA's drought monitor for November. If I go back to May, the last time I held one of these webinars to present agricultural credit conditions survey results, we mentioned at that time in the first quarter we were starting to hear burgeoning concerns about dry weather conditions in some parts of our region, and I showed the drought monitor at that time, and it actually looks not as bad now relative to where it was over the summer. But you can see basically this picture kind of sums it up. You can see the worst, driest conditions were really manifested in Montana, especially eastern Montana, and then also in western North Dakota and western South Dakota. One thing you can see on this chart is that we have some portions of southwest Minnesota, eastern South Dakota in particular, no longer in drought conditions, and that's consistent with what we're hearing from lenders in those areas, who told us that even though conditions were dry over the summer, they got very timely rains late in the production season right before harvest, and that ended up actually leading to better yields than they were expecting. We're hearing reports like that kind of scattered across that region, across parts of Minnesota and South Dakota, and you can even see in parts of North Dakota as well. So for certain producers, it's going to actually be a pretty good year, because they're probably going to end up getting a better than expected crop, and they're going to be able to take advantage of high crop prices. In other parts of our region, yields are going to be down quite a bit. I expect that as more production estimates start to come in across our region, we'll see that. But on balance, the effect of higher crop prices appears to be bolstering incomes and outweighing somewhat the effect of the drought on production. And that kind of gets into the last result from the survey that I want to share with you this morning, which is a special question that we asked about drought conditions, because we knew this was kind of the biggest issue on folks' minds this year. We just asked, what's been the impact of a drought this summer on financial conditions of the farm operations in your lending area? And what you can see, the takeaway from this is that the majority of lenders told us that indeed the drought was having a negative impact, but most of them put it in the modest category. In fact, more than half, 57%, said that the net effect of the drought would be a modest negative impact. 21%, so just about a fifth, came in telling us that it wasn't going to be a significant negative impact. So those are going to be folks from those drier areas, probably people who are lending to ranching operations that are facing a shortage of hay. And in fact, there were a few respondents who told us that on balance, the impact of the drought would be positive. And if you look at where those respondents were coming from, they're going to be folks in those areas where they saw not as severe drought this year, or timely rains at the end of the season, and they're seeing yields coming in better than they were expecting. And again, their producers are going to be actually able to take advantage of the bump in commodity prices that we're seeing as a result of reduced production in the aggregate this year. And so certain producers in our region are actually going to be benefiting just due to those conditions right now. If you didn't have a severe impact on your operations of the drought, it might end up being a good year for you. But again, the majority of lenders telling us on balance a negative impact from drought. Just want to kind of preview before I turn it over to questions. Carmi mentioned some of our upcoming webinars that we'll be hosting soon. She put a link in the chat, so I won't spend a lot of time talking about them. I'll also mention that I have a manufacturing survey in the field right now, and we'll be releasing those results in early January. And then the big show in January, we'll be hosting a regional economic conditions conference. And with that, I'm going to turn it over to Carmi, and it looks like there are a few questions that have already come in the chat.
If you've got questions for Joe, go ahead and type those in the chat box on Zoom. And Joe, let's start with that chart of land values. You mentioned that you thought the negative land values in North Dakota and Montana were being impacted by drought, but what's behind that great surge in Minnesota, South Dakota, Wisconsin?
Yeah, thanks for asking that. So a little bit more historical context here. Over the last decade, roughly, we saw in the early part of the last decade, we saw really strong growth in land values and sustained through about 2015, corresponding with that period where crop prices were really strong. In fact, there were some concerns at that time about whether farmland was in a bubble. Over the period since about 2014, 2015, when we saw commodity prices come back down, we did see some retreat in land values. If I were to show you the chart over time, you would see them turn south a little bit. And this is true, by the way, nationally, and also just if you look at the individual states in our region. We saw some of the fastest growth in the country in Minnesota, North Dakota, South Dakota especially, and just generally speaking in the Great Plains and Corn Belt states saw the fastest growth in land values during that period of accelerated growth in the early part of the last decade. So in some sense, we've now had several years owing to low crop prices where land values were retreating from those highs. So in some sense, this is maybe just a return back to the levels that they were prior to that. And I think that's associated largely with the stronger crop prices that we're seeing right now. The value of land should be tied to what you can produce. The value of what you can produce on an acre of land has gone up because crop prices have gone up, and we see that reflected, and that's going to be reflected more closely in our rents, because those are really directly tied to the economic or production value of the land, and so you'd expect to see those rise together. Land values have risen more than rents. There's a couple other things to point out about why that might be the case. One is, as I showed earlier, interest rates on farm loans are very low right now. It's very cheap to finance. I didn't plot it in that series that I showed you earlier, but if you go to our website and you read our survey results, we also ask about real estate loan interest rates, and those are down in tandem with those other rates as well. So it's very cheap to borrow to purchase land. And the other thing I'll point out, we had a number of lenders comment that there haven't been that many land sales, so the overall volume of sales is pretty low. And we know that when a parcel of land tends to come up for auction, people nearby who really have been eyeing that piece of land for a long time sometimes get into a competitive bidding situation, and the conditions are kind of ripe right now for people to really try and maybe outbid each other a lot. So there's a lot going on there, but ultimately I would point to the stronger commodity prices and to low interest rates as being the main factors behind that.
Thanks, Joe. A couple of questions from the chat. Number one, do you think that increasing crop input costs are going to impact those land values in the near future?
Yes, thank you for asking that. And I should have mentioned that in my talk. We did get a number of comments about that as well. So I mentioned the supply chain disruptions. We didn't ask a special question about that this time, but we got a number of unsolicited comments from lenders about really strong increases in the prices of fertilizer, chemical, as well as equipment, and of course fuel as well. And those are all squeezing producers' margins as well. So as I mentioned, agricultural producers are experiencing those supply chain disruptions just like other industries, and it's led to pretty big spikes in input costs for certain agricultural inputs, and we have heard about that quite a bit. On balance, it seems like the growth in commodity prices is offsetting that. In fact, more than offsetting it, because we're seeing growth in incomes. But it is squeezing margins for a lot of producers, and I think we're going to hear about it going forward. We did hear some lenders express concerns about this elevated input price environment going into next year. So while their outlooks are optimistic for the fourth quarter, some of them mentioned that they're expecting maybe greater pressure on input costs in the coming year.
Thanks, Joe. One last question before we wrap. Is it a fair assumption that the responses from the ag bankers that report the weaker trends or the more negative trends are primarily in the Montana, North Dakota parts of the region suffering from drought, or is it a bigger picture than that?
Yeah, no, I think that's a fair assumption. I mean, I'll point out that the largest share of respondents that we have are from Minnesota. But if you just look at because we do get a relatively easy number of respondents to look at the individual level responses. I mentioned there were 58 bankers that respond to this survey. We can go through individual by individual and look at their responses, and you can see that the most negative responses that we got were from lenders in the most drought-stricken regions. It's worth pointing out that actually one of the more optimistic or bullish comments that we got was from a lender in part of North Dakota, which you would assume just looking at the drought map was extremely dry. But they said that the producers in their area were doing very well. We're getting better than expected production, and it was going to be a good year on balance. And so the picture does vary quite a bit geographically, even within the regions that were most harshly affected. And I think that even more so than geography, it's commodities. So wheat producers and small grain producers in Montana, where they've seen total losses of crops, and then they've had fires, they've had plagues of grasshoppers. They're really having a very hard year. And as I mentioned, so are the livestock producers, and that was reflected in those comments.
Great. Thanks so much, Joe, for your time. And thank you, everyone, for joining us. As you close out of this webinar, we'd love to get your feedback on the survey that pops up. And we will be following up with each of you with an email next week with a link to Joe's slides, as well as a copy of the video for this presentation. And we hope that you'll join us in a few weeks for our upcoming webinar on conditions in the construction sector on December 3rd. Thanks all. Have a great day.
Thank you.